Good morning. Welcome to this week's edition from Interactive Brokers. Joining me to discuss the market impact of last week's comments from Fed Chief Powell at the Jackson Hole Symposium is Steve Sosnick, Interactive Brokers Chief Strategist. Welcome, Steve. How are you?
Morning, Andrew. I'm doing well, thank you.
All right. So it's Monday morning. We're going to try and turn this podcast around today as quick as we can. Stock markets last week, Steve, they continued their rebound from that heavy selling from earlier in August. And they took a lot of comfort from what Jerome Powell said when he stated on Friday that September would pretty much mark the onset of the interest rate cutting cycle. Could you give us your insight into his remarks in Wyoming last week?
Yeah, I don't think he said anything new, actually, quite frankly. He pretty much told us at the last FOMC press conference to expect rate cuts in September. More or less said the same thing on Friday. To me, is very interesting because rate markets didn't move very much on this, whether it was the CME FedWatch tool, whether it was our own Forecast X platform, looking at bond market yields. None of it moved very much. Stock market loved it because the stock market is in its own little momentum driven frenzy right now. They could smell all-time highs. Who knows? We may be hitting them as we're taping this shortly after the open. And so that's what they're all about. Chase the momentum, latch on to the good news. The markets have been ahead of the Fed for a while, actually for years, because in 2022, after Powell spoke and the market sank, it was because he didn't confirm a Fed pivot, which was hysterical considering the Fed then was in the midst of a rate hiking cycle, and he basically said we're going to continue to do so. But markets have been hoping for this for so long. He confirmed the pivot. I guess that's good news to have it confirmed. But realistically, it didn't change anything other than if you were inclined to speculate before and chase momentum before, he more or less gave you a green light to do so, again on Friday.
But so the big question to me is whether it's 25 or 50 basis points. And I'm going to go out on a limb and say that they'll ease by an immediate 50 when it comes to the September the 18th meeting. Would you agree or disagree with that?
I disagree. We'll see where the numbers come out. And then again, this is where I think the risk is that the stock market heard the confirmation and decided that means 50. Again, the other markets did not do that. They're still looking at relatively modest probabilities for 50. They haven't really changed very much. He didn't tell us anything about the magnitude or the ongoing pace. He really just confirmed that you'll get something in September and left it blank. Here's why. If the Fed is data dependent, we have a lot of data coming down the pipe, right? We've got jobs numbers a week from Friday. We've got
Mhm.
PCE deflator. We've got CPI. We've got PPI. This is a Fed that has been dragging its feet about cutting rates all along. Why are they suddenly going to jump in the pool and say, you know what? We've been reticent to do anything for the last year and a half, 2 years. Sure, let's go all in and let's give the market exactly what it wants. There's nothing in his comments or in the comments from other Fed governors that indicate to me that they're really willing to do much more than 25 basis points until or unless circumstances really dictate. So I'm not going to take the possibility off the table, but it's really not something we should be wishing for because it means that the data would stink.
Well, let me push back a little bit further. The government made one of its infrequent revisions last week to a year's worth of employment data, and they said that the non-farm payroll number has been overstated by 818,000 jobs, I think. Don't you think that would have some impact on the overall mix? We're moving away a little bit from the fear of inflation to a cooling economy. Doesn't like the lack of about a million jobs change your view on what they might do with interest rates?
Yes, because now it's brought the dual mandate into play, whereas before it was more or less the focus on the single mandate. But that doesn't mean that they're willing to jump right in. First of all, 800,000 jobs in the course of an economy that has over 150 million people employed is actually not that big of
Okay.
a difference. From a data watcher's point of view, yes. From a giant macro point of view, we're a country of 330 million people or so. So 800,000 is a rounding error and literally what it is. And so, it's telling us that the job market is not aflame as it was before. It was on fire and was very much balanced in the way of workers. I guess if you're selling your labor, it was very much of a seller's market there. It's flipped a bit more into equilibrium. But bear in mind, yes, I mean, we're way off our lows in unemployment, but 4.3 is a historically very enviable unemployment rate. That doesn't
Mm-hmm.
tell me we have to panic in and do anything crazy to keep people employed. There's other statistics that show that layoffs are not really increasing at a big amount. I would say we're actually somewhat in balance. And in balance does not mean that you have to do anything drastic. It just means you adjust. That's where I continue to lean on this 25 basis points because I think it's an adjustment. The other thing to keep in mind is the last employment figures, they poo-pooed it, but there was a big temporary increase in joblessness from Hurricane Beryl in Texas. Let's see if that reverses itself in the next set of numbers. So there's a lot of moving parts. There's nothing to me that says we are in such dire straits that the Fed has to really just abandon all the caution that they've been putting in for all this time and just say, you know what, we're all in. You know what, you guys want rate cuts? Fine, you're going to get them. What is in there that says that?
Okay, let's move on to
Sorry.
markets. That's really what I wanted to talk about this morning, Steve.
Exactly.
You're very close when you say we might be at all-time highs by the time we finish this podcast, pretty much. I'm looking at the chart now. We're very close to it, but we're eking up. There are two notable earnings reports coming out that both caught my eye this week. We've got the big one being Nvidia on Wednesday, I believe, but we also have Crowdsource, CRWD. That's the company whose software glitch last month brought Microsoft Windows users to a halt. How important are these reports this week?
I'll deal with the second part first. CrowdStrike is interesting, but I mean, it didn't move the whole market before when it was glitching out. I mean, I think it's the nightmare scenario. And someone described it as that was the Y2K problem that we waited for in 1999, and it occurred randomly in 2024. But realistically, it'll be interesting to see if you're a CrowdStrike investor or someone who's been trading the stock. It's crucial because you really want to know if this has damaged the company in a longer term way. But from a market moving point of view, it didn't really move the market all that much when the whole world was glitching out and took down stocks like Delta and stuff like that. It literally took down other people's brokerage platforms. So I think it's interesting. Nvidia, on the other hand, I hate to put too much weight on one company's earnings, but I have to in this case. This market is all in on the AI theme. All right. And NVIDIA is the poster child for the AI theme. It has been a phenomenal company, a phenomenal stock, a phenomenal investment, a treacherous short, however you want to look at it. I can't think of a company that has a better track record, put together like a better winning streak of beating earnings, beating top line, beating bottom line, beating on every other metric, raising guidance, then turning around the next
Mhm.
quarter, doing it all again, and then raising the guidance more. At some point, you'd logically think, okay, they might be able to beat because managements are very good at beating 80, if 75 to 80% of the managements do it, why wouldn't NVIDIA? But the question then becomes, can they continue to raise the guidance at the pace that they've been expecting? When the stock was flirting with 100, I would have said that's not as crucial. When the stock is, 130, 130 plus, I don't have it, I don't have my screen in front of me. That's a lot different. It's been a very big rally. So to me, there is so much riding on it because if they give any hint, as Sundar Pichai did for Alphabet or Mark Zuckerberg did 2 quarters ago for Meta, that this money is all being spent, but it's not really getting to anybody's bottom lines, and that the spenders on AI are digesting it. They're not necessarily giving up on it, but it's going to take some time. We've heard if Meta and Google are both telling you that it's going to take some time for AI to reach their bottom lines, it's probably going to take a bit longer for it to reach the average company's bottom line. And that's really what it's all about. There's some neat things going on, but ultimately, for this to be the economic success that's been driving the stock market, it's got to hit the bottom lines of the end users, not just the bottom lines of the providers, whether it's the providers of hardware and software, such as NVIDIA is the ultimate hardware provider, but you've got AMD, you've got ARM, or the software providers, which is Microsoft, Google, Meta, et cetera. And so if NVIDIA gives any whiff that this is slowing down, it affects all of them. If they say it's great guns and people are going crazy, that's fabulous too. Then we can continue to rally, although I think a lot of it's been priced in over the past 2 weeks. And then there's some other company specific news, which not being an NVIDIA analyst, I won't get too deep into, but there have been some delays about one of their chipsets, the Blackwater, I believe it's called. Finally, this is not to be ignored. Jensen Huang has sold what is it, about 300 million, $500 million worth of stock in the last few weeks. I tend to wonder, like, maybe he knows something a bit more than you and I might. You know,
I often feel on that front that everybody's got to put the kids through college, though, Steve,
you know,
at some point.
he doesn't want to have to take out loans for any of that stuff. Actually, he probably does. He probably does take out loans against his stock, which just appreciates like crazy. But to me, it's very interesting that you've had Warren Buffett basically tell you that he's cautious on the market and cautious on big tech. Not in so many words, but through his deeds with selling Apple and keeping as much T-bills on hand as the Federal Reserve pretty much. And Jensen Huang telling you that, you know what, I've held this stock forever. And now I've decided that this is a good opportune time to really lighten up on it. He still owns bucket loads. So it's not like he's giving up on his own company. But these are the little things in the background that make me think, you know what, maybe a little caution's in order, but caution is not the word the market wants to hear right now. It's just not.
Right. Gotcha. Steve, thank you very much for your insights this morning, and we'll come back to you in next week, I hope, and keep well out there.
Sounds good. Take care, Andrew. Bye.
All right. Don't forget, audience, to look for our other recent episodes at IBKR Podcasts under the Interactive Brokers Education menu. Thanks for joining us. Bye for now. Thanks, Steve.
Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd.,